Hey everybody, thanks for tuning in. And today I wanted to talk to you about the methods or the different options that are open to people when it comes to funding property deals. So for the sake of argument and to make it easy, we'll work on two different parties. So we've got the property investor, so that's a person who is going out, finding the deals, structuring the deals, putting it all together, managing the refurbs, getting the work done. So we'll call that person the property investor, and we'll call the person who is putting the money up the funder of the deal, just for ease really, and to keep things clear. So as I say, there's a number of different ways of structuring these types of deals, but to my mind there's probably four that spring to mind, which are the easiest ways of and the most hands-free ways for the funder, because invariably people who are looking to put their money into property deals typically don't have the time, most importantly, but quite often don't either have the experience or the experience, the expertise, the inclination really to actually get involved. Quite often they're just very, very time-starved people. So that's why it's a perfect partnership really, working with somebody who's a full-time property investor. That is their day job. So as I say, there's four main options. Option number one is a very, very simple, straightforward money loan, where the property investor will find the deal, and they will structure it in such a way, and they will provide the funder with a straightforward set interest rate, either on a monthly or an annual basis, whichever works, and that will be set over a predetermined time frame. So from the investors, the funder's point of view, it's very nice to be able to know exactly how long your money is going to be tied up, what return you're going to get on that investment. So very, very clear cut, very simple for both parties. So that's option number one. Option number two is the what we call one for you, one for me. Now what this entails is the property investor, the full-time property person, will go out, they'll find the deals, they'll source it, they'll put the package all together, they'll work out the actual deal, the structure, the refurb, they'll manage the whole process right the way through, end to end, right the way through to refinancing. And the first deal will be financed by the funder. First deal will go in the funder's name, and then the second deal will go basically into the property investor's name. So it's literally one for you, one for me all the time. But right the way through, the funder obviously puts the money in, and the property investor will do the legwork and do all the hard work, find the deals and get it through. And that can obviously go on and on and on indefinitely, until obviously there's a mutual agreement that both parties have got the same number of deals and you walk away from it, or it just keeps on going indefinitely, depending on what the fund of money is and how quickly you can recycle the money out. So again, fairly straightforward in so much as the two parties are not tied into the deal, except in a fairly basic agreement, just saying that there'll always be one for you and one for me until that comes to an end. Option number three is a full-blown JV agreement, or JV partnership. So that's obviously a joint venture partnership where both parties, you've got the full-time property investor, you've got the funder, and they come together, join typically a limited company together, and effectively jump into bed properly. Now that's obviously a very, very potentially long-term agreement, so it's important that both parties have got their values are the same. Everybody wants the same thing out of the deal, both short-term and long-term. You're in it for the long haul. And the way it works, again, the full-time investor goes out, finds the deals, the funder puts the money into the deals, and then invariably, once the property has been bought, refurbed, packaged up, refinanced, it's not, more often than not, 50-50 split down the middle. That can vary depending on what is agreed up front, but typically 50-50, and you both end up with a share of the equity, a share of the cash flow every month, And again, it's similar to the one for you, one for me. But you just keep on rolling until the cash runs out. But if you can, if you're buying the right properties in the right area and you can recycle that money, then that's another good option. But as I say, it's very important that that both parties are going to it with their eyes open, because there's a lot of kind of administration to that side of it. You're obviously linked on your credit files, you're tied into it together. There's obviously ongoing stuff every year where you've got confirmation statements and obviously annual accounts, etc. And you've both got to be aware that you're in it together. So that's number 3, and final one, number 4, is a deal packaged arrangement where you've got the full-time property investor sitting there, again finding the deals, doing all the work, structuring everything, and the funder, providing they want to build a portfolio on their own, they basically just buy that deal from the deal packager. So they'll pay normally a sourcing fee and also a project management fee for actually running that job. Obviously, the funder then gets to build their portfolio. The property investor doesn't get to build a portfolio, doesn't have any kind of a share of a portfolio. They are literally just finding deals and packaging them up and earning a living by doing that. So those are the four key areas, the 4 key options, I would say. There is a 5th option, which is literally just sourcing. So the investor, the full-time investor will go out and they will just source a deal for the funder. The downside of that for the funder is that the sourcer then just walks away at the end, hands the deal over, takes their sourcing fee, and then the funder will then need to spend time in actually running the deal, putting all the trades teams together, getting it refurbed, working out all the finance, getting it refinanced, working with brokers, etc. And as I said earlier on, typically people who are looking to put money into property deals don't have the time or the inclination to get involved in all of that stuff. So that's probably less of an option in my mind for proper professional people that are looking to fund deals. Anyway, hope that has been helpful. If you want any more information, by all means, drop me a line or comment below, and be happy to pick up on any of that with you. One thing I would just say as well, just as a caveat to all of that, is it's important that when you're looking at working with investors on these kinds of deals, funders, is to be aware of the FCA regulations, understand PS 13.3, which is a document that basically outlines what you need to know with investors, the kind of questions you need to ask, i.e. are they a high net worth individual, sophisticated investor, and it's just a checklist really to make sure that you're asking the right questions and identifying the investors correctly before you start going into investing deals with them and potentially breaching FCA rules and regulations. So that's the only caveat to this really, but just to understand that the rules around that. But anyway, thanks for watching. Hope to see you all again soon, and take care. All the best. Cheers.